Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Well, welcome back, Art Jarvis. Taking Stock. And we're going to say episode 27 ultimately, but this is episode number 1 of season 2 on Taking Stock.
Onward and upward.
How you doing?
I'm doing fantastic. How you doing?
You know what? Used to hear this a lot. Couldn't be better and have less.
There you go.
Which means I'm doing the best I can with what I got. And what we have right now is some beautiful weather here in Cincinnati town, Loveland town.
Yeah, it's good for the mood, isn't it? We've had, 3 or 4 beautiful days in a row, so it's good for the psyche, that's for sure.
But the temperature's on the rise. How about the stock market?
No, not so much on the rise. Well, depends on what day you're looking at it, I guess. Because we're on the rise, we're not on the rise. Right?
Or what minute?
Yeah, that's exactly right. Exactly.
Offline, as I just said to you, when we were talking offline, was, I'm watching the Art Jarvis red and green, because if you're watching, it's like red, green, so, and it happens, throughout the day right now. You said we're at that little bit stuck in the mud.
Stuck in the mud kind of situation, yeah. Well, number one, we're heading into what I call the summer doldrums.
Right.
And I always make the wisecrack. That's everybody in New York heads off to the Hamptons or wherever it is they go. So volumes start to drop and things like that. There's less quotation mark interest in the market, but the other problem with heading into this is we've had such a strong run since the fourth quarter of last year, October 27th, to now. We're up. I think the S&P 500 is up like 26% for that 9-month period, and the problem right now is there's really just not a great reason from an interest rate standpoint or a corporate earnings standpoint. Not really a great reason for the market to continue substantially higher. We've been banging around that 5,350 kind of area, a little bit above, a little bit below. But there's also not really any good reason for the market to drop substantially either. So I think that's the game we're playing right now. It's just like, well, we pushed it up yesterday, and man, we're going to take some profits today. Overall. This week we start with the inflation numbers again, so we'll hit the inflation number tomorrow. The CPI number will come out, and then the Fed is meeting today, and the Fed should make their announcement tomorrow about what they're going to do with rates. But the vast foregone conclusion is they're going to do a whole lot of nothing tomorrow. So there's not enough fuel to push us in a direct one.
I was going to use that fancy word, impetus.
That's a good one.
But fuels, I like fuel better, to be honest with you.
Yeah.
So I like your word.
Oh, thank
Fuel's
you.
good. I mean, it is. It's like what fuels the marketplace. Sounds better than what impetus is driving it. I like what fuels the marketplace. And by the way, so since we're talking about what might happen tomorrow, just for listeners, I don't know what day you're listening, but as Art and I sit here right now, we are talking and recording this on Tuesday, June the 11th. And that's why those numbers are coming in on Wednesday. I kind of laugh. We do the recording on Tuesdays, every other Tuesday, and those doggone market numbers or whatever information is being released by the feds and stuff always comes on like the Wednesday
almost always on the Wednesday, unless they have a surprise for you. And it's the surprise that gets things going, right?
Sure.
October 27th of last year, when we spent all last year talking about the potential impending recession and more rate increases and things like that, which of course the recession never happened. But the rate increases all of a sudden on October 27th. It's like, not only are we not going to raise rates anymore, we're going to actually cut rates a couple of times in 2024. Well, here we sit almost at the middle of 2024, and we have not seen any rate decreases, right? So.
And thankfully, no increases either so far in 2024. All that's that stuck in the mud a little bit, which, I like the idea that there is no fuel that's, raising, or driving people to do certain things or for the market to rise. I don't know what you call it if you say fuel is what causes the rise, but there's no fuel leak that's seeing the market drop either. So, when stuck in the mud, it usually has a bad connotation, but maybe it's not so bad to be holding steady a little bit with, ups and downs, and it's not really gains or losses.
Yeah, I mean, you make a great point. I mean, it's, when you have a 26% move in, let's just call it 9 months, coming up on 9 months, that's substantial. So, there's not, if you look at what is the fuel is either corporate earnings, so corporate earnings are moving up, that would be additional fuel, or interest rates are dropping, which would be additional fuel, and we're not in that scenario right now. The earnings aren't dropping and they're not going up substantially. And interest rates, if you're looking at the 10-year Treasury note or bond, it's literally kind of stuck between like 4.33% and 4.67%. So, one day, I think today, last time I looked, we were at 4.43. So we're just stuck in this narrow range. But normally what happens is a narrow range continues to get a little tighter, a little tighter, a little tighter.
Right.
And if I was a betting man, which I am, it's clear I've made a career out of it. But, when you get into, and it's almost, if I could show you, again, this is not a TV show, but it almost starts to look kind of like a pennant. You get tighter, 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 and then you have an explosive move one way or the other. So, there is an election coming up here pretty soon, so maybe that's the, using your word, impetus, it gets us heading in one direction or the other. But, but you make a good point. It's stuck in the mud or taking a breather is not necessarily a bad thing.
Right.
Yeah. And there's things you can do. We've talked about this before. It's not an all or nothing kind of situation. It's, if we, the nice thing is after 11 or 12 rate increases over the last few years, we can go get a money market at 5.25%. We can go buy short-term U.S. Treasuries at, 5.4, 5.5%. So there's alternatives out there that, if we want to settle in and just, if the market's going to trade sideways and we can make an annualized 5.5, why not do it?
Right.
The trick of it is you better be ready, because when you do start to get that move, you don't want to miss out on that move.
That's always the trick.
Yeah.
Is, that whole buy low and sell high, and just make sure you don't miss.
Is that the goal? Buy low and sell high?
Somebody said that. But that's that whole thing. Hey, I always like to rat you out to whoever's listening.
Okay.
Like I say, Art is actually in his right hand.
Right.
He's holding the market in his right hand. But I just want to rat. He's taking a little bit of a rest, taking a little bit of a break. Art is not holding the market in his left hand or his right hand right now. It's nearby. He can pick it up and look and see what's red or what's green. But I like to keep him informed of what's happening during our discussion.
Yeah.
Real quick, talking about the numbers that are coming out, CPI and the inflation numbers that are coming out tomorrow.
Sure.
What are your thoughts? I mean, what do you kind of expect from inflation number? Nothing.
No surprises. I mean, honestly, I think we're literally we're at 2. So if you look at the CPI, the Consumer Price Index, we're at 3.4% right now. That's a good number.
Yeah.
I've told you before that
right.
for my work, 3 is good. If you want to go down to 2, it's like I can make that work also, even better. And then the one that the Fed supposedly pays so much attention to, the Personal Consumption Expenditure Inflation Index, which is always a mouthful. We'll go with PCE. That's actually at 2.7%. So that's that number's getting it's as we talked at the beginning of the year. I don't think it's going to head straight to 2%, and it might take quite some time to get to 2. But at least it has a 2 in front of it.
Well, they're the ones. The Feds are the ones that they want to. They're pushing. Their goal is to get to 2. Again, repeating your own words. 3's good.
Yeah.
Yeah.
Oh, definitely.
So,
and there's an interesting thing there, which for me might be the more interesting part tomorrow, is to look at some of the components of the consumer price index, because you look at some things, and probably should get you some graphs so you can post them and put them in the slideshow part of this podcast. But like last month, like eggs were down like 20-something%. So like on a year-over-year basis, eggs were down 20%. But home insurance and car insurance and insurance products were up like 20-something% over a year. And we're seeing this. I mean, I'm sure I'm not the only person that has seen, a 20-something% increase in insurance rates and obviously taxes. If our housing value goes up 40%, your taxes are going to go up. So,
are we allowed to say COL, cost of living?
100%.
So everybody across the board, cost of living has gone up.
Easily.
In all of those areas that you just discussed, whether it's insurance or groceries or whatever, we're seeing, just the restaurant. I mean, the car. People are still out doing things. I still scratch my head. Regardless, I hope it doesn't become some kind of a bust when we find out everybody was doing it on credit and it's come due or something. I hope that's not the case. The one number in terms of credit is our national debt number, which is just scary at how fast the wheel spins there. But without getting into that, sticking with us at home, I'm going to throw this into the middle of our conversation today. We kind of talked about what the market is doing right now, and a little bit of the trends, or the stuck in the mud conversation that we just had. We'll talk about what the inflation number is going to look like tomorrow, which is no surprises. The CPI, not a surprise. Your PCE, which I can't repeat all of those because it's actually more than PC and E. I won't even try. But so we're up to date on that. So I'm going to throw into the middle of this a funky question for you.
All right, lay it on me.
Really for those who are listening. So what's your tip of the day? What's your tip of the day? Like I said, a funky question. What's your tip of the day for our average household, and what's going on in the market and how they can best navigate what's happening with cost of living in the marketplace, and whether it's for their investments or their retirement or just their everyday living? What's your tip of the day?
Yeah, my normal tip is stick with the plan, right?
Right,
so
yeah,
that's getting a little boring, but that's one I definitely always want to emphasize is stick with the plan, and that's no different today than it ever has been. But
well, and I'll throw one thing into that real quick, too, because the other side of that, if you don't have a plan,
get one.
Get with a professional,
right,
that can guide you to create a plan for your tomorrows.
Very much so. There's things that people can do, and they know how to do it. I mean, people, I think they know that if you put the money away, the sooner you start doing it, the better off you are. Okay, but there are things you can do to tweak the plan. Instead of getting 8 yards, you can tweak it and get 9 yards, right? It's so you need to do things like that. But in what kind of vehicle do you put it in, and whether do you put it in a Roth IRA or a normal IRA, and that is determined by your tax situation and things like that. But I think if someone asked me like, okay, I have extra money today, what should I do with it?
Disposable income.
Yeah, a little extra. Power, right? Yeah. So you send it my way. That's what you do with it. But it's the interesting part, and this is kind of, the S&P 500 has done very well for the last 9 months. Say that for the third time, but it has been heavily driven by the larger capitalization weighted stocks, the technology sector, and really the darling of Wall Street right now is NVIDIA. It just continues to keep on going, and it's at last I looked 1,200 and something, and they're calling for a much higher number. So,
and NVIDIA is a company that manufactures a component
of AI.
Correct.
All right.
You got
Just
it,
for
yeah.
For the listeners, I remembered that.
Yeah, no, and well done. That's great. but so it's been like that technology sector, and that has. So what you have seen is like if you have, let's just say the S&P 500 is up 20%, 26% weighted index, but if you unweight the index, you're up 18% or something like that. You know, I have started leaning toward buying some unweighted securities, like some exchange traded funds, because the hope is that the technology sector can't lead the way forever, and hopefully what you'll see is you'll start to see some of that money starting to flow to some of those stocks that have been neglected or lagging. So so that's if I'm given a tip, that might be one of them. That's one thing I'm looking at. The other thing is for a short-term basis, or if it fits your investing criteria and things like that, a 5.5% Treasury, short-term Treasury, is nothing to sniff at, right? I mean, it's. I mean, if I have to have an alternative, I'll take 5.5% if the alternative is zero. So, you got those kind of things, but people keep talking once again. The markets are rocking and rolling. Well, the markets are doing okay, but the indexes are rocking and rolling. And that's because of the tech. And again, NVIDIA is by far the biggest driver right now.
Well, help me understand something. And this is, I'm kind of bouncing around a little bit today, and we're going to get to something we talked about in episode 26 2 weeks ago, and that you and I talked about offline earlier today, even. But now I lost my train of thought. I was going to take us off the rails for a minute anyway.
You head to were you heading toward the S&P 500 sectors?
No, not yet.
Okay,
no, not
yet.
I was going to say, explain to me the. What was it you were just saying?
Talking about the weighted and unweighted indexes
there you
in the
go.
sectors. Yeah.
So explain to me the weighted versus unweighted and what that means.
Oh, sure. So let's take the S&P 500. The S&P 500 has 500 securities in it. That's,
right.
And that's why I use that as opposed to the Dow Jones, which only has 30. That's great, but I want to know what the broader economy or market's doing. But the larger the size of the company, so if it's a Microsoft or NVIDIA, which just passed Apple from a market capitalization basis last week, $3 trillion or something like that, it's a big company. And
that opens some eyes. When you say just passed Apple, who everybody's heard of, and knows is performing well.
Yeah, it's a big deal.
Yeah.
I mean, you look at NVIDIA was trading at a couple $100 a share not that long ago, and now it's trading at $1,200 a share. It's grown substantially from a market cap, which has at the same time giving it much more impact in the index. So since it's a larger company, a larger market cap, it has a greater impact on the index just because of its size. And that's true for Microsoft and the Procter & Gamble's of the world and things like that. They have an Exxon, and things like that. They have a greater impact on the index than some smaller company, whatever it would be, Medtronics or something like that. So you have that weighted index. So, but if you take those same 500 companies and just give each and every one of them an equal weighting, so there's no difference between this little tiny company here and this great big NVIDIA company on this end. They all, no matter what happens to them, they have the same percentage impact on the index. So you can look at that, and it hasn't really been normal here for the last 9 months. Usually the weighted index and the unweighted index are much closer together. Well, right now you've got whatever that is, a 9% difference between the two.
Yeah.
So to me, that shows neglect in certain places and certain sectors, and that as long as you still have good companies and you have good growth rates and you have good earnings, I want to find those sectors or those companies that have been neglected, because hopefully they're going to be the leaders going forward.
Which leads us to some of that conversation we touched on in our last episode, episode 26, and I said, you know what, we need to talk about these things. And so those things, and we don't have to talk about all of it right now,
Okay.
but I mentioned, by what you were discussing in episode 26, hey, you know what, we should spend some time on energy stocks. And, oh, you know what, we need to spend some time on international stocks and maybe where they fit into somebody's plan.
Sure.
So, pick one you want to talk about today. Is it the energy stocks, or maybe you even do wish to speak about both of those, the energy stocks or the international stocks, and how they might fit?
Yeah. Well, let's stick with the U.S. market, or although energy is a global
Sure.
company concept, but let's stick with the S&P 500, which is more of a U.S. index. And energy, whereas technology might be 100 and something companies, the energy sector is probably more like 40 something companies, and you'll have small companies in there, Duke Energy, and relatively small Duke Energy. But then you also have the Chevrons and the Exxons of the world in there, and Chevron and Exxon, I don't even know what the number is on a quarterly basis, but it's tens and tens of billions of dollars in profit that they're making in the on a quarterly basis. It's a big number.
Right.
But the thing is you want to go in different sectors for different reasons. If we're in a fast-growing economy and things like that, you want to buy growthy companies. Okay, so that would be your consumer cyclicals and technology and things like that. But let's say we're kind of in that stuck in the mud kind of situation right now. Maybe you look at like the energy sector, which is more of your steady growers. It has higher dividend yields and things like that. So that keeps you in the market, but it keeps you in the market from a little bit more of a conservative standpoint. So
Well, that's what, you just said, that the higher dividend yields.
Mm-hmm.
And that's what got me going, is that we need to talk more about that with the energy stocks.
Yeah. So look at the technology sector. There's not really much of a dividend to speak of. There's a few companies in it pay, but if you look at the energy sector, you're getting a 3-point-something% dividend yield. So let's say the market's stuck in the mud and it's not going anywhere. At least you're making the dividend yield, or people start to move to the energy sector, which causes the prices to go up, and you benefit from that also. The market psychology and things like that. So, but yeah, it's so let's say you make that change this summer, but then all of a sudden, for whatever reason, the market starts to take off. You're not going to do as well as the market's doing, the S&P, but at least you're participating, right? So you're at least they're getting drug up with the rest of the stocks, and that gives you a chance not to be missing out on a big move up, but also gives you a chance then, to readjust if you don't miss the whole move, if that makes sense. But
it does make sense, because as you said, you're being dragged along with it.
Mm-hmm.
So you're not missing it, but maybe you're not getting the most of it, but you're there.
Yeah, somewhere in there, there's a phrase or something where when the tide is coming in, it raises all ships, whether they're small or big. Right?
Right.
The tide goes out, it's kind of the same thing. The big ships and the little ship boats go down too, but to different degrees.
Right.
So yeah, and so you look at. Well, let's talk about, I was going to say, you like energy, then you also could have, like the consumer staples sector, which is more of your toothpaste and all that kind of stuff of the world, right? People are pretty much buying it, we're buying deodorant and toothpaste, hopefully, no matter what the economy's doing. So it's a higher dividend yield, a little more stable.
Do we call those the toiletries stocks?
Yeah, but that's part of them, toiletry. There's definitely.
That's what I call those things are the toiletries.
It's the stuff you kind of almost have
everyday
to have.
consumables.
Yeah, exactly. It doesn't matter what's going on in the world, you still need these things, right? So, but you made another good point. Is then let's say the whole U.S. market is not doing well. There is the whole international sector. Just because the U.S. market's not doing well, that doesn't mean Europe's not doing well, or the Far East isn't doing well, or somewhere else in North America. Those kind of things. There's other alternatives, and especially this theory or this process was very evident back in like the 80s, where there was a little more. There was not as strong of a correlation between the different regions and countries in the world. The U.S. could be doing terrible, and maybe Germany's doing great. So you move over to Germany, and the problem is here more recently is if you look at it, depending on the alternative, but the global economy, the global markets, and the U.S. market, the correlation has become tighter and tighter. So, there was a reason I named the company Jarvis Global Investments. I wanted to emphasize the global part of the investing. It's not, we don't just go buy the S&P 500 and forget about it. We're actually trying to make strategic moves and finding different correlative parts of the world to try and make you more money when maybe the U.S. isn't doing as well as you like. So yeah, you have all that, and the U.S. we're worried about 3.4% inflation, but Turkey's at 40-something% inflation. So that there's just because it's this way here in our backyard doesn't mean that's how it is down the street. So.
Right. Well, and it hasn't been that long ago where we weren't really a global economy, and we've become more of a global economy. So, your point there is another one, well taken, to think about the fact that we have become a part of a more global-wide economy. And, for listeners, whether it's Jarvis Global Investment or whoever's guiding your financial planning, whatever professional financial planner that is, they need to be on that page too. And we're going to end on today on this note, but we're going to pick up on some more talk about the international stocks and the global marketplace on episode number 28 coming up in 2 weeks. But today, episode number 27, good talk.
Yeah, as always, it went fast.
And of course, it seems like it does that. And as always, we are going to invite you, if you're listening to this, to send a question. You got to have questions. I don't have all the questions. I certainly don't have the answers. Art has the answers. Maybe he even knows all the questions, but we want to hear from you.
I doubt that.
But we would definitely love to hear from you. So catch up with us. We share this podcast, obviously lovelandbeacon.com, but on the Loveland Beacon Facebook page, on some community Facebook pages, and certainly the Jarvis Global website and Facebook pages. So just, comment a question, and we'll add that to our discussion next in 2 weeks from now, which we decided is the 25th of June. We were talking about that earlier.
That's
so,
correct, yeah.
But we'll be back, Art. Hopefully you'll agree to join us and continue this Taking Stock. Season 2, Episode 2 will be coming up next, but this is Episode 27. Thanks for being with us today, Art.
Oh, it's a pleasure. Like I always say, I enjoy this, so you bet I'll be back.
Well, happy to have you. And to all of those of you who tune in and listen, thank you, too, for joining us. And until next time.
Thank you very much.
You bet. Thank you.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.